Hey guys, what's up? I'm Erin and welcome back to the channel. If you're near retirement age, there's a good chance you've heard of RMDs, or required minimum distributions, the required minimum amount that the IRS dictates that you must take from a traditional tax-deferred account once you reach a certain age. But what you might not know is that some of the most common mistakes people make with RMDs are totally preventable. Today, I'm going to walk you 3 big RMD rules and show you how you can avoid penalties, confusion, and unnecessary taxes. Let's dive in. Let's start with RMD rules and aggregation. What you can and can't combine. Let's start with the basics. Who actually has to take an RMD? If you have a traditional IRA, SEP IRA, simple IRA, or workplace retirement plan, like a traditional 401k or 403b, you're required to begin required minimum distributions starting at age 73 if you reach that age in 2004 or later. But here's the thing, not all accounts follow the same RMD rules. Roth IRAs are the exception. They do not require RMDs during the original account owner's lifetime. Inherited Roths may have RMD requirements, but the good news is those RMDs do come out tax-free. If you inherit an IRA or an employer plan, whether traditional or Roth, you are generally subject to RMD rules right away, regardless of your age. IRA Aggregation Rules. Here's a common situation so many people find themselves in. They end up with multiple IRA accounts, and no matter the type, whether they are traditional, simple, or SEP, this is where things can get a little bit tricky and where mistakes can happen. The first step here is that you must calculate the individual RMD for each account you have. But you can take the total amount from just one or any combination of your IRAs. So let's say you have 3 IRAs and that your total RMD among these 3 IRAs is $10,000. You can take this $10,000 distribution from just one of your IRAs. That's totally allowed. But this only applies to IRAs. You cannot combine IRAs with employer plans. When it comes to workplace plans like 401ks, aggregation is not allowed. If you have multiple 401ks or multiple traditional employer-sponsored plans, you must calculate the RMD for each account separately and then take each RMD from each respective account. Even if they're the same plan type, the IRS will treat them as separately for RMD purposes. There is one twist. If you have multiple 403b plans, you can aggregate those RMDs. You would still need to calculate the RMD for each 403b plan that you had, but then you could take the total amount from any one of your 403b plans. But keep in mind that you cannot combine the 403b with the RMDs from IRAs or 401ks. And importantly, spouses must each take their own RMD on their own IRAs. And this one trips people up all the time. Even if you're married and filing jointly, you cannot take your spouse's RMD. Each spouse must calculate their own individual RMD amount based on their specific account balance and their age. Then each spouse must take their own RMD respectively. An easy way to remember this one is that the I in IRA stands for individual. Here's a common mistake. Let's say we have a husband who has a much higher IRA balance, and so he decides, I'm just going to take out enough of an RMD from my account to cover both my RMD and my wife's. What's the big deal? At the end of the day, it's going to be the same dollar amount, and it's all going on the same tax return, right? Well, here's the problem. He satisfied his RMD, but his wife didn't take hers, and now she could face a 25% penalty for missing it, or 10% if it's corrected in time. Again, my favorite way to remember this one is that the I in IRA stands for individual. There is no joint IRA. If you find you did miss taking an RMD, you can request a waiver of the penalty by filing IRS Form 5329 and explaining the reasonable cause. Failing to understand these rules, especially the aggregation rules and spousal separation rules when it comes to IRAs, can lead to costly mistakes and surprise penalties and unnecessary taxes. And these really aren't intended to be gotcha rules. The IRS is just looking to capture taxes that have been allowed to be deferred on these accounts for decades. So what you need to do is be precise, stay organized, and maybe just don't make assumptions about your RMDs. Mistake number 2, RMDs cannot be rolled over. All right, this is another big one. If you're doing a rollover from a 401k to an IRA and you're already at RMD age, say 73 or older, you must take your RMD first. Why? Because RMDs are not eligible to be rolled over. If you include your RMD in your rollover, it becomes an excess contribution to your IRA and it can be hit with a 6% tax penalty every single year until it's fixed. Let's meet John. He's 73 years old. He has a 401k balance of $800,000. He's subject to RMDs this year, and he's thinking about rolling his 401k into an IRA. Since John is 73, the IRS uses a life expectancy factor of 26.5. So John must withdraw $30,189 this year to satisfy his required minimum distribution. And yes, that amount is taxable. Now, step 2, this is where things can get tricky. Before John can roll over a single dollar into his IRA, he must take out his full RMD, and he cannot roll that amount over into an IRA, Roth or otherwise. Once the RMD is withdrawn, the rest of the account is eligible for rollover. After withdrawing $30,189, John has $769,811 left. He can roll that into a traditional IRA, and here there would be no immediate tax bill on the rollover. He would continue taking his annual RMDs going forward. The taxes are paid gradually as withdrawals are made, and this option keeps things simple and defers taxes. Alternatively, John could do a Roth conversion. Now, theoretically, he could convert the entire amount, but if he did, this would be added to this year's taxable income and would likely push John into the highest tax brackets. It would also trigger IRMA Medicare surcharges and increase the taxes on his Social Security. But once this money is in a Roth, no future RMDs would be required in the tax-free growth, and this money would grow tax-free, and any future withdrawals would be made tax-free. At age 73, timing and tax strategy matter more than ever. Remember, John can't convert his RMD. He has to take his RMD and pay taxes on it. Now, he can convert any remaining amount as he so chooses, but remember, while the Roth IRA is attractive, converting too much at once can do more harm than good. Remember, it's pretty unlikely that John is going to want to convert this entire balance over to an IRA all in 1 year. That would have a really big tax bill. A smarter, more efficient strategy would be to do partial conversions over a long period of time. This would reduce his tax bill. In this situation, he would convert just enough each year to stay within a targeted tax bracket of his choice, and this would also likely avoid IRMA thresholds and big tax spikes. And as he's gradually shifting money over to a Roth through this strategy, he would still have to be taking his annual RMD once he reaches RMD age. Before rolling over a large portion of his 401k, John needs to step back and consider his full financial picture. John very well may have alternate income streams like Social Security, perhaps a pension, maybe he even has a working spouse, and all of these different income streams add up, and so too do taxes. So before converting, John should ask how much room is left in his current tax bracket. Will a rollover push him into a higher tax bracket or trigger Medicare IRMA surcharges? Would a partial conversion make more sense? Or should he wait until a lower income year to convert anything at all? The bottom line is rollovers at 73 are absolutely possible, but they're more tax sensitive than ever. And remember, you have to take your RMD first. Then you want to step back and ask this question. Does a rollover fit into my broader retirement income plan this year? It's not just about moving money, it's about managing your tax burden for the long haul. The next area common for mistakes is the spousal beneficiary exception, which is a huge planning opportunity. Spouses have a unique advantage when they inherit an IRA. They have two options. Option 1 is to treat it as their own IRA. Here they get to roll the inherited IRA into their own IRA. Now they can delay RMDs until they reach the age of 73 or age 75 starting January 1st, 2033. In this situation, it pays to be mindful of the 10% penalty that is in play if you take withdrawals from the account and you're under the age of 59 and a half. Option 2 is to keep it as an inherited IRA. In this situation, the account remains in the deceased spouse's name. The spouse can access the funds penalty-free at any age, and importantly, RMDs begin depending on the deceased spouse's age. Let's look at a real-world example. Let's say we have Susan, who's 60 years old. Her husband, Mark, age 70, recently passed away with $600,000 in a traditional IRA. Susan is the sole beneficiary. Now, as the spouse, Susan gets two powerful options that no one else would get. Susan can treat the inherited IRA as her own and move it into her existing traditional IRA. Now she can delay RMDs until she reaches RMD age, and because she's over 59 and a half, she can withdraw funds without any sort of 10% penalty. This is simple, efficient, and a great option if she doesn't really need the money right away. Alternatively, Susan can keep the account titled as an inherited IRA, Mark's IRA, for the benefit of Susan. She can access the money at any time, penalty-free, even if she were younger than 59 and a half. She can delay RMDs until Mark would have turned 73, or she can use the 10-year rule and empty the account balance within 10 years. This can often be the better choice for younger spouses if they need flexibility and to access this money prior to the age of 59 and a half. So what should Susan do? Well, since she's over 59 and a half and doesn't really need immediate access to this money, rolling it over to her own IRA makes a lot of sense. But there's also something else that Susan can consider, which is a Roth conversion. Now her household income is likely much lower. She likely just has Social Security. She doesn't yet have to take an RMD. This could be a great opportunity to convert and stay in a lower tax bracket. But first, she'd need to roll the inherited IRA into her own traditional IRA, and then she can do a Roth conversion. Especially since she can still file as a qualifying widow for up to 2 years, this can give her access to wider tax brackets. After that, she'll file as single, and that's when the widow's penalty hits. That means paying more in taxes on the same income, simply because she's filing single, plus a higher risk of Medicare surcharges and more of her Social Security being taxed. So while this is a painful transition, this is really a golden opportunity to do a Roth conversion, stay in a lower tax bracket, and reduce future RMDs. When a spouse inherits an IRA, they have multiple options, and what's the best option for them depends on their current financial situation, their age, and what their long-term goals are. It really depends on your own situation, so make sure to talk with a qualified financial planner if this is a situation you find yourself in, and weigh each option carefully so you choose the one that fits best for you. Spousal beneficiary options are a huge planning opportunity, but only if you understand the rules and choose the plan that works best for you. I hope this video helped to clarify some of the confusing RMD rules. If you've made it this far, let me know what concerns you have around RMDs. Leave them in the comments down below. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I'll see you soon. Bye. Today, I'm going to walk through 3 big RMD rules and show you how you can avoid. Each spouse must calculate their required minimum distribution based on their own It's a lot of words. Failing to understand these rules, especially aggregation. If you're doing a rollover from a 401k to an IRA and you're already at RMD age, say 73 or older, remember, John can't convert his RMD. He has to take his RMD and pay taxes on it, then he can convert anything that's left as he so chooses. But, well, spousal, I can't say the word.